Okay, welcome to the Beginner and Small Account Training Group for Thursday, January 10th, 2019. And the disclosure is that Aramir is not a broker-dealer or securities investment advisor. I am also not a broker-dealer or securities investment advisor, and so there are no specific trade recommendations in this session. Everything you see and hear here today is for educational purposes only. Options involve risk and not suitable for all investors. You always trade at your own risk, and past performance not dictate future results. I encourage you to stop the recording or pause the recording and read the fine print later. Okay, great. That's another disclosure. That's some other stuff. So let me go back to my PowerPoint here and just look down it for a second. Thanks for joining in today. I have, I guess, a mishmash of things that I want to talk about today, and anything else that you want to talk about, let me know. But I thought I'd try to do a little bit of, I don't know, back to basics stuff today, at least a little bit of it. And it turns out that I can use credit spreads and butterflies as an example of what I want to talk about, which is a little bit about margin control. Last week we talked about measuring portfolio performance and margin to a certain extent. Today this will kind of expand on that just a little bit. Then I want to read a section or paragraph or two from the latest Think Money magazine. Those of you who are customers of Thinkorswim should be getting that magazine, I don't know, once every 3 months or something. And sometimes there's some pretty good things in there, and it points out a few things that I'd like to expand on a little bit. And then if we run out of time, or if I still need more to talk about, we'll talk about looking for credit spreads or cash secured puts or something like that a little bit. Okay, so that's on the list for today. Biochemistry. Do I have a biochem background? Well, my bachelor's degree was in microbiology back in 1981, a long time ago, University of Washington. And but to get the degree at that time, we didn't have to take much biochemistry itself. I had a lot of chemistry, but very little actual biochemistry. And so now that I can go back and audit the classes almost for free, I thought it'd be fun to go back and see what biochemistry is all about and how they're teaching it. And I'm learning that they know a whole lot more about it today than they did back in 1981, and it's much more detailed than anything that we even talked about in microbiology classes. So yeah, it's fun. I enjoy it. Torture yourself. Yeah, I guess you could say that. I am actually reading the textbook too, but you know, I don't have to take the tests, and it's okay. So I'm kind of whacked out strange in thinking that it's fun, but it is kind of fun. So I think if I was an undergraduate student now, it might be fun to major in that, because I think there's a lot of it could be a good career. You know, so anyway, I'm really enjoying it and really seeing all the kids in there and how they're struggling life or death to get a good grade in that class. And anyway, that's what I'm doing in my free time lately. Okay, let's start with Think Money. Now, I didn't take a picture of this. The latest issue, I got it, I don't know, a few days ago. It has a yellow cover, and the title says How to Save a Bear in a Herd of Bulls. Know when to take profits off the table. There's an article about that. But I want to talk for a minute about another article they have in there that's called Portfolio Theory for the Little Guy. Okay, and they're trying to explain what portfolio theory is and a twist on it, and that's what I want to talk about a little bit. So let me just read a few sentences in a paragraph out of that article for you. Question is just, what is portfolio theory? In simple terms, portfolio theory is about increasing return for a given risk level. Say you could invest $10,000 in strategy A or B. Strategy A has a potential return of $500 and a maximum risk of $1,000. Strategy B has a potential return of $700 and a maximum risk of $1,000. All things being equal, portfolio theory suggests you'd be better off investing in strategy B. For the same level of risk, you get a higher potential return. And then it goes on to talk about, however, there are systematic and unsystematic risks. Systematic risk is when stocks are pulled up or down by the overall market. Unsystematic risk is company-specific risk like earnings, news events, corporate uncertainty, and so on. You can reduce unsystematic risk with diversification, but you cannot reduce systematic risk in the same way. It goes on to explain that a little bit further, and then it talks about index funds for a minute, and it says a fund may come close to matching the performance of a benchmark like the S&P 500, but you give up some flexibility. For example, if you think energy stocks might underperform, and if the index has significant weight there, you can't call up S&P and SM to kick out the energy stocks, but you can remove or reduce positions in individual equities by managing a stock portfolio yourself. So what they're saying there is one reason why you can do a better job of diversification along the lines of your personal feelings or outlook for the economy than just buying into an index fund if you want to do that. And that example, if you think energy stocks are going to underperform, then you could still be diversified, but just not including energy stocks, and you'd have a portfolio that would better fit your outlook. It goes on to talk about a few things, and then it says, but if you don't have much money in your account, how can you buy a bunch of stocks to create a portfolio, especially when some of them cost hundreds of dollars per share? If you buy 100 shares of each, of even just a few stocks, it can add up to a good chunk of money. That's all true. In theory, you could match the S&P 500 index by buying shares in all 500 stocks in the index individually. But that would add up to a lot more than just participating in an index fund that mimics the index or in the index itself. And then they go on to something that I found interesting. It's not something I thought about too much about, which was an alternative using options. It talks about using creating a long delta portfolio in stocks to reduce unsystematic risk through diversification by using either long calls or short put verticals or long call verticals or diagonals. And what they're talking about here is, instead of buying the stock or an index fund or the index itself, buy call debit spreads on enough different stocks to get you the diversification and reduce your unsystematic risk. But by using options and the leverage that they have, you can do that for a lot less money than you could if you did it with shares of stock. Even if you did odd lots like 10 or 20 shares of stock, it still hit up to quite a bit. But with call verticals, you could do say 30 different stocks, call verticals and 30 different stocks, and be diversified. Now, let me read you the paragraph that talks about an example. So it says the debit of a long vertical depends on the stock's price. For example, the debit on a long 200/205 call vertical, trading with a stock trading at 200 and 250, might be $260. You could potentially have a portfolio of long call verticals and 20 individual stocks at different price levels with a total debit of less than $5,000, not including commissions. And that's all true. I found this really interesting. The one thing that it doesn't say is if you did that, since options have a expiration date, you'd have that portfolio, that diversified portfolio of call verticals, for a limited time. Now, if you use leaps, it could be a year and a half. It could be even up to 3 years on a lot of stocks. If you use monthlies, it could be a month or less. Weeklies, it could be a week or less. What that means is if you establish it for, let's say, $3,000, if they expire, you're going to need to reestablish it for another $3,000 or whatever the premiums are then. But in the meantime, perhaps all those will make money if the market goes up. I found that very interesting. I just wanted to amplify it a little bit and read it here and talk about it for a minute. The article goes on to talk about accomplishing the same thing using short put verticals. These are put credit spreads that are out of the money generally, and it's the same idea. Out of the money put credit spreads are a bullish strategy. If you look at the graph, which is like this example here on my screen, you can see it makes its money to the upside and it has losses to the downside. That's a bullish strategy, just like covered calls, call debit spreads, and even owning stock. So the theory here is the same. You could establish put credits out of the money, put credit spreads in 20 or 30 different stocks and be diversified and reduce your unsystematic risk. Same thing, however, this article does not mention time. And so these are going to expire whenever they expire, and you'd have to reestablish the position. So it's a limited time frame diversification move. Now, I think if I was going to do this, I would diversify across time, let's say I did this on 20 different stocks to get diversified that way. Of those 20, some might be 3 months, some might be 9 months, some might be a leap, that kind of thing, so they don't all expire at once. I think that would also further help reduce your risk. It goes on to talk about long call diagonals, which are simply where you, let's go into a stock. Let's pick something. How about J&J? Disclaimer, I do own J&J, so it's in my portfolio. But a long call diagonal is where you sell a near-term one and buy a further-term one at a different strike. So it makes a diagonal across strikes as well as across time. So if we did this one here, well, they're talking about calls. So let's just do a call diagonal. We're going to buy a diagonal. And you can see the template in Thinkorswim comes right up. We're going to sell the short term. We're going to buy something further out in time at a different strike. In this case, a higher strike. And it looks something like that. Same idea. You could get diversified this way as well. Now, I haven't talked about diagonals much. There's a lot of people that trade them as their own trade. I have not done that much. I have used it as adjustments at various times. But the idea of a call diagonal can look like this if the strike's higher. If the long strike is lower, it kind of flips it, and it can look like this, which becomes more of a bearish strategy than a bullish strategy than a bearish strategy, because it makes its money to the upside. And you can see, if you go far enough, it looks more and more like a call debit spread would, or a put credit out of the money put credit spread would. So they're all similar in that respect. They have different Greeks, they have different characteristics, and most likely different adjustment strategies if you're going to trade them. But I wasn't intending to get into call diagonals as a strategy today. Maybe I should do that sometime, but not prepared to do that today. So that was that article. I thought it was very interesting. You can get diversified with options, and it can cost less than doing the same thing with stock, but with limited time horizon that you need to watch out for. Okay. Let me go to the next article here. Obviously that wrong, so I didn't write the page number down correctly. Here we are, page 30. Pages is 35. An article is entitled "The Hidden Risks of Index Trading." Now, the article talks about why SPX and ES don't track each other directly, and that's what I want to expand on a little bit. But it's just a short article, and it doesn't really go much further than that. But there's a paragraph that I'd like to read and talk about for a second. In comparing the /ES S&P 500 mini futures contract with the S&P 500 index itself, the question is, why are they not at the same level, and why do they move a little bit differently? They're not directly correlated. Same level talks about this. The ES right now is at 25.95, whereas the SPX right now is at 25.96. That's pretty close, but sometimes they're 10 or 20 points away. And you might say, if the ES is an S&P 500 futures contract, why is it different than the SPX? In fact, in this group, somebody asked me that question a month or two ago or something, and I didn't have a good answer. And this article kind of explains it. So let me read a paragraph to you here. There are 500 individual stocks that make up the SPX. Many of these stocks may trade actively, with transactions occurring every second. Others may trade less frequently, every few seconds or every few minutes. Here's where it gets interesting. The SPX changes when the last trade price of any component stock changes. Meanwhile, the stock's bid and ask prices might be above or below the last trade price and more accurately reflect its current value. But until the stock actually trades, the SPX value does not change. So it does not necessarily reflect the current value of all 500 stocks. The SPX then is a snapshot of the last trade prices. The ES feature, on the other hand, is its own product, and it is not tied directly to the S&P 500 stocks. That means the value of ES is determined by buyers and sellers of the futures contract. If traders think the S&P 500 will rally, they'll buy /ES and drag its price up. The price of ES does not have to wait until all 500 stocks trade. If the ES traders think a stock that hasn't traded yet has a higher or lower price, they'll adjust their ES trades accordingly. That's about the gist of this article, and it's the answer to the question of why don't they trade exactly the same like you might expect. You know, I think that's a pretty good answer, and I learned something there too, that SPX is based on the last trade price of each of its component stocks, whereas ES can reflect bid and ask and other things, but not necessarily just the last trade price. Now, I, for one, sometimes get up in the morning before the market opens, and I look and see what the ES futures are doing. And like last night, they were down about 12, if I remember right. And we had a situation like this where ES was below the SPX. I don't remember exactly what it was, but let's say that ES was 15 points below the SPX, and it was down 12. Well, it doesn't mean that SPX is suddenly going to drop 15 points to be equal to the ES at the open. Doesn't mean that, but it usually does mean that if ES is down 12, then the SPX will probably go down at least 12 immediately on the open. Now, a few minutes later or half hour later, that correlation probably breaks down, but it's a good indication that they'll go down probably at least as much by the change in ES right at the open. Again, since SPX has to wait for the last prices and all 500 stocks might not trade for the first 5 minutes, let's say it's 5 minutes before they all trade, then the value of SPX won't be accurately known until that happens. We'll know, but it's only based on the last price of some of the 500, but not all 500 stocks. Okay, so I hope these two comments here that I did and excerpts of this article was interesting. I hope I was able to explain it a little bit further and show how you might look at the numbers. Anyway, I thought it'd be useful to do that. So let's see, a question from Craig. Do you recommend verticals or diagonals with the risk reward of your last two examples? All right, well, let's look at that. So in this example, this is a diagonal. What is the risk reward? The risk is whatever the maximum it can lose, which is $985 in this case on J&J stock. If it should go down to zero, and you expire it, that position would be minus $985. What's the reward? Or in other words, how much can this trade make? Well, up here it can make $15, but I think right here it's a little higher. It is. It's 20. Let's call it $25, $26. Okay, so 26. Sorry. So 985 divided by 26 is a risk reward ratio of 37.8. Risk is 37 times the reward. By comparison, wide iron condors can be somewhere around the 9 or 10 risk reward ratio. Thinner ones, since you get a lot more credit, can be in the 3 or 4 range. So all trades are different. So the question is 37 to 1 acceptable risk reward ratio? My answer to that is you have to, it might be, it might not. You have to think about a couple of things. First, you have to think about your personal risk tolerance. You know, if you can afford to lose $985, no matter what the possible reward is, but if you can handle that kind of loss, if that is a very small percentage of your portfolio, or it fits into all the percent ratios that they say you should use, as far as, you know, no one investment should be more than 2% of your portfolio and stuff like that. Or whether or not it does, a loss like that would not make you stop trading and go get a job somewhere, then it might be acceptable. Part two of the question is, can you manage it? And I don't mean can it be managed, because any risk can be managed, but can you manage it? You know, is it within your skill level to know that you could do something to this trade when it's only down $300 or $400 that might still allow it to make money? That's another factor of managing the risk. If there's no obvious adjustment you can do, or you don't know how to do it, or you know, whoever's shown you how to do this hasn't said what the adjustment might be, or something, any of those factors, probably maybe you can't do it. But the other main part of this answer is, what is the expected return? Okay, let's say if this trade had a 99% win rate and a 1% loss rate, and that 1% loss rate was all $985, not something that you managed to $300 or $400, would it be worth it? Well, to do that, get my calculator here, and let's say we have 0.99 times 26 minus 0.01 times 985 and I get 2.29 or 2 hours and 29 cents. That's a positive expected return if it has that kind of win rate. And so this trade might make sense to do in a case like that. But if this trade had a 50-50 rate, then it would be 26 times 0.5 minus 985 times 0.5, or negative $479 expected return. And clearly, the trade in the long run over a huge sample size would not be expected to make any money at all, and I wouldn't do it. So now I can't say what the probability of win versus probability of loss would be on a trade like this. That's something that you can answer by doing your back testing, or seeing back testing, or having done a lot of them yourself, or there's probably other mathematical ways to calculate that based on probabilities. I do know, for example, with the parking trade, we could make about $80 on a parking trade per month at a risk of about $2,000, and we had about a 95% win rate and a 5% loss rate, and you do all that, and I think it turns out to be positive, and so I did the trade, and it, over the long haul, was profitable. So that's how I would answer your question. Last thing being, however, if you had this trade on and you couldn't sleep at night because you were worried about it, then I couldn't recommend the trade, because you can't, you can't live your life that way. Either trading it too big or it's too risky overall, but might not be suitable for you if you're going to worry about it the whole night every night. Okay. All right. Let's see here. Let me look at my notes. Talked about that and that. Oh. So I want to talk about margin management just a little bit, which is akin to saying risk management. Hang on just a second. Okay. I got computers beeping all over the place. Why did this one beep? Oh. No. No big deal. I think it was saying it just got mail, but it blew up and I can't see what the mail is, so I'll deal with that later. Let me clear this out. Let me bring up, I had an example, just 1 second. Get ready for that. I had saved an example and I cannot find it, so I'll just have to regenerate it probably. Wait, is that it? Nope. Ah, here it is. Okay. All right, I got that. All right. I'm going to go through several different examples here, strategies, to make my point about margin management. But you may have heard, if you're in a butterfly or even a road trip and you have to control the capital, it's too high, then one of the things we can do is roll up the bottom long. Well, I want to talk about why that works and why that's a good idea, and why that's a specific example of a more general concept that you should know for almost any kind of trading that you're doing. So let's start with a simple example. Let's say that you had a credit spread on SPX. You go to SPX, clear this out. Say it was out of the money. I don't know. I'm just going to randomly pick some strikes and make a credit spread, okay? Okay, there's one. I'm not recommending anything. This is not a trade. Don't go do this. It's just an example of what I want to point out. This example, I would have sold the 24.90 and bought a 24.80. It's a 10 wide credit spread, and I would have been paid $55 for doing that. Graph looks like a typical credit spread does, and you know, if you're a spread trader or if you use this kind of thing as adjustments, this should look pretty familiar. Okay, but note that it's $1,000 margin. Technically, it's a little bit less than that. It's $1,000 minus 55, and you see that over here when you look at the expiration line. That's $945. That's the maximum risk. But Thinkorswim is just saying they're going to take $1,000 margin for putting this trade on. All right. So if you wanted to, if $1,000 risk was too high, well, let's make it an extreme example. You did 20 of these. You got $20,000 of risk here. If that's too high, if the limit for your implementation of this strategy was, say, $11,000, you need to do something to reduce this risk or reduce the margin, right? Now, if you think about a butterfly, well, let's just work up a butterfly so I can also point to that. We're going to buy a butterfly. Again, I'm not recommending anything. I'm just picking strikes at random to use as an example. Let's say it's a balanced butterfly. It's 20 points wide. Let me uncheck the credit spread for just a second. So there's a butterfly. Nothing unusual about this. And again, let me make it 10 of them just to, for example. Now, your maximum risk on this one is $350, okay? You paid a debit for it, but you paid $350, so the most you can lose is the 100% of what you paid. Well, let's say that, let me make it a more extreme example. Let's make it 50 wide, so 24.20, 25.20. Okay. Maximum risk $2,200 here. Let's say that that is higher than your risk that you plan to handle for a trade like this. So what's the standard thing that people do is they roll up some of these longs, all right? Well, that would simply be a debit spread. So we're going to sell some 24.20s and buy some 24.30s. And I'll just model up a debit spread. And it would look like this, okay? And you can see that if you look at the graph now, it's $1,220 instead of $2,200. If the amount of risk that you were planning to use on this trade was $1,500, then this one simple little adjustment would get you under that risk, and that would be one way to control your margin on this butterfly. All right. But note that this is just a debit spread. If we look at the adjustment by itself, it's just a debit spread. And so the bottom line answer here is to keep in mind is debit spreads can reduce risk against a wide range of other strategies. So let's go back to where I started. This put credit spread, you need to reduce this risk. What's the simplest and easiest way to do it? I do analyze opposite trade. That's just a debit spread, just like other debit spreads. It happens to be that the strikes perfectly line up and cancel out all the strikes. Essentially, this is removing the trade. That's one way right there is remove the trade. Then you won't have any risk. But let's say that you wanted to still be in this trade and still try to make some money, but just reduce the risk a little bit. What could you do? You could take off half of them. You know, same idea as before. Takes off half the risk. It also reduces the profit potential. But if you have different strikes, it can be even more manageable. So let's change these to a 25.30. Let's go above it. 25.30, 25.20. Now I've added a debit spread above my put credit spread, and I've done it for half of the lot size. Okay. Well, look, I have reduced the margin by half. I still have profit potential, albeit in a limited range, but that might be acceptable for the strategy. And so I've stayed in the trade, I've reduced my margin, and I still have profit potential. And up here, I have only $150 loss to the upside. Now before, I had $1,100 profit anywhere to the upside. That's the trade-off or the downside of this. But I have cut my risk in half. What if, instead of putting the debit spread in front of the put credit spread, I put it behind it? Well, let's work that up. So how about 24.70 slash 24.50? No, let's make it the same at 24.60. Right there. Okay. It's 35 cents debit. What has happened now? Well, Thinkorswim, it didn't change the margin. Why is that? Because as this put credit spread goes in the money, it will realize its maximum risk, which was $18,900. But we have limited the range of prices at which it will realize that. Now it's saying the same 20,000 risk here because the maximum risk is 20,000 minus the credit at any point to the downside, but it's only for a limited range. Now further on down, we have reduced the risk to $7,175 if the market should go down that much. All right. What if I did all 20 of them? Same idea. At some point, the maximum risk is still 20,000, so it has not changed it here. It's showing us the highest theoretical risk. But if the market goes down enough, we even have a profit to the downside. So that's how that would work. And I think even if you did 30 or 40 of them, you're still subject to 20,000 risk at some point, but again, within that limited range. So why am I pointing all this out? Because if we look at another example, of a butterfly. Let me work up a butterfly. I'll just pick some random strikes again, not recommending anything. And let's make this 50 wide. So 25.50 on the top, 24.50 on the bottom. And let's say we did 5 of them. Okay, graph looks like a butterfly. 21.50 is the maximum risk on this balanced butterfly, but it's still risk just the same. Think about what a butterfly is. It's the combination of a put credit spread and a put debit spread if you're doing a put butterfly, where the shorts of each of those two spreads are the same strike. That's what makes a butterfly. So here, if you just look at the graph, we have shorts right here, and we have longs here. Okay, that's simply a put credit spread. We have longs at this higher strike price and shorts at this lower strike price. That's simply a put debit spread. So all you have is a debit spread in front of a credit spread, just like my other example was. If I work up the opposite trade here, we not have the debit spread, basically, might look like this. Okay, and I have to make the size equal. Well, a butterfly without the credit spread component, sorry, without the debit spread component, is simply a put credit spread. Okay, and this is the familiar put credit spread graph. All right, well, then essentially what a butterfly is is a put credit spread with a put debit spread in front of it. And they composite out to make this kind of a graph that we all know is a butterfly. So a put debit spread can be anywhere, any strikes, depending on where it is in relation to the put credit spread portion of the butterfly, or the put credit spread trade in and of itself, if that's what you have. The margin can be reduced over a wide but not full range, or it can be reduced completely if it's in front of the credit spread, and reduce your risk. That's why we do the debit spread adjustment. Road Trip uses debit spread adjustments quite a bit, not only for controlling margin, but for hedging if the market's dropping. The reverse Harvey is a hedge, essentially, to the upside. Bad example. The debit spread adjustment is a hedge to the downside, and we simply add debit spread, say, here and here, or even up here and up here, depending on where the market is, and it reduces our total risk. In so doing, it changes the Greeks, which essentially reflect reduced risk, and it's our way of managing the trade to the downside. Okay. There's one more thing I'd like to point out here. Let me load up this example. Let's see here. Where did it go? Get this over here so I can see it better. There. Okay, let me uncheck this for a second. Here's an example of a put credit spread. And for whatever reason, you want to roll this down. Well, if you did roll it down, one thing you could do would be you would simply take it off. Ignore this butterfly for a second. You'd take it off by doing an opposite trade, and then you'd reestablish it at a lower price by doing another one. Let's say at 2,500, 2,470. Okay. By so doing, what I've done is I took it off and I added another one. That's all I did, and it repositioned it. Strikes are now short at 2,500, whereas they were short at 2,520. So I rolled it down 20 points in this example. All right. Well, look at what we did here. We've got a put debit spread and a put credit spread. What is that? That's a butterfly. So you can do the same thing in one trade by just doing a butterfly with the strikes chosen so that it rolls the put credit spread down. So I was short 2520s, and you notice this butterfly roll is buying a 2520. I was long a 2470, and this butterfly is selling two 2470s, which undoes the long that I had, and sells another one, which is going to be the new short, and then another long somewhere below it makes a butterfly. And if I click this, you can see that it has repositioned the put credit spread down from the shorts being at 2520 to being at 2471. Now, if I did it right, and I didn't, but if I had done it right, the margin doesn't change. Let's fix that. The original put credit spread was 50 points wide. If I made this butterfly 50 points wide, let's see, 2420 would be 50 down. It should not change the margin. Correct, it does not change the margin. So I call this a butterfly roll, and I think most people do. If you ever hear somebody talking about that, this is what they're doing by doing a butterfly roll. Or this is one thing they're doing by doing a butterfly roll. So I hope that helps explain what we're doing when we do a butterfly roll, or when we want to do adjustment against most any other strategy. Okay, so did all that make sense? I I hope it did. That's what I was trying to show. A while back one day I talked about most any strategy or most any structure can be easily morphed into most any other structure, and this is an example of that, although it's morphing into simply another put credit spread, but a repositioning by adding something to it. Maybe if you'd like, I should talk more about that morphing idea, because you can take iron condors and morph them into calendars or diagonals. You can take butterflies and do the same thing. You can change spreads into other spreads. You can calendarize a butterfly either partially or completely, which amounts to being diagonals. You can do all this stuff. The basic structures are just building blocks of strategies or other things, or adjustments or other things that you can do. Okay. Well, I think I might stop there. It's close to an hour. Let's see, don't have any more questions. I hope this made sense. Think about this kind of thing. Maybe work up some examples like this if you want to burn it into your brain. It's the same thing they tell you in biochemistry: is get a bunch of problems out and work the problems. Or when you're learning mathematics, work the problems, and the more you do that, the more you understand it. So it's the same kind of thing here. Although I think a lot simpler and a lot easier than biochemistry or calculus. But I like to go deep into things and things way over my head just for fun, and so that's my hobby, I guess. Let's see, Mark says, am I back in the market? So Mark, I have one trade on right now. It's not a road trip, but it is a butterfly. As far as size goes, I'm about 10% of the size I had been trading at. Now, I wish it was a little higher than that, and so I may actually add a trade in the next few days or the next week if we get an opportunity. It's kind of in between windows for all the trades that I do in terms of days to expiration. We've got, well, this is a possibility for a road trip, I suppose, 78 days. It's at the tail end of the window that I usually use, but it's possible. So with this, but I already have a 15 March on, so I don't think I want to do another one. These are too far out, and these are too close for what I do. So kind of in limbo a little bit in that respect. Maybe in a week or so that'll change and I can get something added on. I am trading cautiously in this market. We're having VIX below 20 again, but it had been something like 30 only a few days ago. I think there's enough bad news potential on the market that we could have more big swings, both down and up. I think if they should solve some of the problems they're facing in Washington, D.C., we could have a huge update, So it's not just a matter of being worried about or protecting myself to the downside. It's a matter of being worried about huge swings either way or both ways. And that's why I'm not going in as much as I used to at this point. I don't know when that'll change. So I guess you could say I'm taking it easy, and I do feel like I'm on vacation. So I guess that's what I'm doing. But I would like to get another trade or two on pretty soon. Okay. All right. Well, thanks you guys for joining today. Again, I deliberate for a while over what I should talk about in here and what would find helpful or useful. So I hope you found it useful. And if you have suggestions, let me know. And otherwise, yeah, have a great weekend and week. And we'll talk to you guys next week after I've had 2 more biochemistry classes. So who knows what I'll be thinking about then. Okay. Bye, everybody.